Good day, welcome to the lesson, and in this lesson we're going to look at the conceptual framework. It's basically the first chapter that you look at in financial reporting. In this chapter we're going to look at the definition of a conceptual framework. We'll look at the advantages and disadvantages of a conceptual framework, the objectives of general purpose financial statements, underlying assumptions when preparing financial statements, qualitative characteristics that financial statements are expected to have, the elements of financial statements, recognition of elements of financial statements, and measurement of elements of financial statements. You will notice that this chapter is a beacon, a focal point for a lot of other chapters that we're going to be looking at in the rest of the financial reporting syllabus, and therefore it might look qualitative and a lot of people skip it, but it's important that you go through it, understand it, and much of the material is quite examinable, especially the material coming down there. So let's get right into the chapter and get to feel a bit more of what's needed. First of all, back in the year 1989, international standard setting bodies developed what they called the Framework for the Presentation and Preparation of Financial Statements. This provided some guidelines on how accounting should be done, and it was replaced in the year 2010 by what's called today as the Conceptual Framework for financial reporting. It is this document, the Conceptual Framework for financial reporting, that we will look at in this chapter, or that we are concentrating on in this chapter. Basically, a conceptual framework has been defined as a statement of generally accepted theoretical principles that forms a frame of reference for financial reporting. This conceptual framework is not to be confused with GAP. Sorry, let me get that right. We'll look at GAP as we go on in the chapter, but a conceptual framework is just, think of it as a single document that forms a frame of reference for financial reporting, and it serves two main purposes. It describes the concepts that underlie preparation of financial statements, so it basically helps with preparation of financial statements. And number two, it helps international standard setting bodies in the development of international accounting standards. We'll see how that is useful as we proceed in the chapter. The main components of a conceptual framework, when you go read your notes, as follows. You expect that it has chapters. Number one, it will describe the objective of general purpose financial reporting. Two, it will describe what a reporting entity is. It will then describe, or it describes the qualitative characteristics of financial statements, underlying assumptions when preparing financial statements, the elements of financial statements, recognition of elements of financial statements, measurement of elements of financial statements, as well as the concepts of capital and capital maintenance. Most of this chapter is just based on this material, so if you know this, then you'll be good to go in this chapter. Before we proceed, a conceptual framework has many advantages and disadvantages. And some of the advantages of a conceptual framework, if you saw what we looked at there is that it sets some rules for preparation of accounting standards, and therefore it avoids a firefighting approach to development of accounting standards. It reduces patchwork output in the sense that there's already a set framework for development of international accounting standards, and therefore we simply need to go and look at those frameworks when developing international accounting standards. It reduces political pressure in that it's not easy for politicians to just come up and say, hey, let's develop a standard and let's do it in so and so short a period of time. As we'll see in the next chapter, for a standard to come up, there's need to follow all the rules in the conceptual framework. There's need to follow a set of steps when developing those standards, and that kind of avoids bowing down to political pressure. The disadvantages are that even though these standards are set by international standard setting bodies, we may not easily implement them in all countries, because some countries will decide to adopt and others may not adopt. Then a conceptual framework would ideally presume that all users are the same, but it's not true that all users are the same. And following through from this idea, a one standard fits all approach to preparation of financial statements and standard setting is also not plausible, and yet that's what the conceptual framework really follows. I earlier talked about gap, and that gap should not be confused with a conceptual framework. A conceptual framework, as we discussed, is simply a document, right? One framework that forms one set of rules that forms a frame of reference for financial reporting. Gap, however, refers to, and we should have a definition somewhere there, okay, it refers to all the rules from whatever source which govern accounting, whereas a conceptual framework comes from international accounting standard setting bodies. GAP can refer to anything as long as it provides us the rules for financial reporting. And some of the sources of GAP, okay, examples of sources of GAP, if you are asked for them, are National Company Law, and in Zambia it's a Companies Act which provides some rules on how companies should do their accounting. Okay, so it provides some of the rules that govern accounting. Another source of gap in the Zambian context, national accounting standards. And in the case of national accounting standards, the Accountants Act has provided delegated authority to the Zambia Institute of Chartered Accountants to then prepare or stipulate what accounting standards are to be followed in Zambia. And prior to 2005, Zambia had its own national accounting standards, but then Zika adopted international accounting standards and international financial reporting standards to replace those national accounting standards. And so the third source of gap that we have in Zambia are international financial reporting standards. Another source of gap are local stock exchange requirements, and in the case of Zambia, it's a Securities Act 2006 which provides the rules for the preparation of accounts for listed companies. The list of gap could go on and on and on, but these are some of the main sources of gap that we have in the country. Then one would ask, what are the objectives of financial statements? General purpose financial statements have got many objectives or purposes, but for the purposes of our course, let's think of it in terms of three main objectives. Number one, to show the performance of the financial performance of a company. Number two, to show the changes in the financial performance of a company. And number three, to show the financial position of a company. Now, the financial performance of a company will be shown in the statement of profit and loss and in the statement of cash flows. If this is most likely new to you for some people, but that shouldn't be. Changes in financial performance are shown in the statement of profit and loss and the statement of changes in equity, as well as a statement of cash flows and director's report. We will look at this one, and that one, but we may not concentrate on the director's report in this course. Finally, the financial position is simply shown in the statement of financial position. So basically, three objectives of general purpose financial statements are: one, to show the financial performance; two, to show the changes in financial performance; and three, to show the financial position of an entity. As we're preparing financial statements, there are some assumptions that we make, and the conceptual framework stipulates that the key underlying assumption, one key underlying assumption, is going concern. If you remember from financial accounting, going concern is simply the assumption that the entity or company will continue in existence. Okay, it will continue in existence oops let me just handle that. It's just the assumption that the company will continue in existence for the foreseeable future. Foreseeable future. Okay, so if you are presuming that the company will continue in existence for the foreseeable future, then you account for everything as if you are continuing in existence. Otherwise, if we are not presuming that the company will continue in existence for the foreseeable future, we would have been preparing things on a break-up basis. But we presume going concern, we presume that the company is continuing in existence, and so we go with a going concern assumption. There are arguments in some books that there are two underlying assumptions, which are going concern and accruals, but then if you are asked for one, it's just the going concern. But then some people argue that there's also accruals, although some will argue that accruals is just mentioned as a by the way assumption in the conceptual framework. If you are asked for two, you would need to mention going concern and accruals. If you're asked for one, the key one is going concern. Accruals is simply the assumption that transactions are supposed to be recognized in the period in which the transaction occur, rather than when cash changes hands. So you basically be recognizing revenue in the period in which it occurs, rather than when cash exchanges hands. And you'll be recognizing expenses in the period in which the expense occurs, rather than when cash changes hands. And so you'll be matching, when you're dealing with accruals, there's also an idea of matching. You'll be matching expenses in one period with revenues that occurred in that period. So basically, those are the two underlying assumptions when preparing financial statements. The conceptual framework provides 6 main qualitative characteristics that financial statements need to have for them to be useful to the users. And 2 of these are described as fundamental qualitative characteristics. Need to sort that out. 2 of these are described as fundamental qualitative characteristics, while 4 of these are described as enhancing qualitative characteristics. Okay, so the 2 fundamental qualitative characteristics are faithful representation and relevance, while the 4 enhancing qualitative characteristics are comparability, understandability, timeliness, and verifiability. I have this mnemonic that I created to help us remember. If you notice, the first 2 are FR, and we're doing financial reporting, so faithful representation and relevance. And then we all like watching TV, right? Hopefully, maybe. So we like seeing our TV, so CUTV, FR, CUTV, to help us remember the qualitative characteristics that are required of financial statements by the conceptual framework. Please, if you mention anything away from here, those wouldn't be the ones by the conceptual framework, and they would not be marked right. So try as much as possible to stick to these and remember them like this. And also, I'd encourage you to be using mnemonics as you are preparing for your examinations, so that you remember a lot of things quicker. The next thing we want to look at as regards the conceptual framework are elements of financial statements. Now, I tell you something. If you're busy right now and you've just been running through this video, at this moment, please pause. Make sure you come and do this when you can fully concentrate, because you cannot miss what I'm about to tell you, because it will keep on coming back in the rest of the lessons that we'll be doing. In fact, for the rest of financial reporting is just about how we account for this. Every transaction that you make in your financial statements falls under either of 5 groups. Each of these groups is known as an element of financial statements. And these elements, or broad classes or groups in which transactions fall, are assets, liabilities, equity, income, and expenses. If you mention anything away from that, it can be an element, but it's not an element as prescribed by the conceptual framework. So the conceptual framework highlights 5 main elements of financial statements. You will notice that 3 of these sit in the statement of financial position. Okay, so assets, liabilities, and equity sit in the statement of financial position, while 2 of those sit in the statement of profit and loss. This has come up a lot of times in exams, and you'd be amazed how students just get it wrong. So 5 elements of financial statements are assets, liabilities, equity, income, and expenses. 3 usually in the statement of financial position, and 2 in the statement of profit or loss. The definitions of each one of these as prescribed by the conceptual framework is also important. An asset is simply a resource controlled by the entity as a result of past events, and which is expected to result in an inflow of resources to the entity, embodying economic benefits. Let's break it down. By the way, in case you forget anything or everything there, simply think of an asset as a resource controlled by an entity. Now, a few conditions need to be met for this resource to be called an asset, and these are the ones that come after that part. Again, if you forget everything about a liability, think of it as simply an entity's present obligations. So any entity's present obligations is a liability. Equity is just the company owner's residue interest in the assets of an entity. Of course, there are other conditions after that. Income are increases in economic benefits during the accounting period. Expenses are decreases in economic benefits during the accounting period. Does that mean that everything else that remains after that is not important? No. Everything is important, and so let's try and break down what follows after those summary definitions. An asset is really a resource controlled by an entity, but it has to be controlled as a result of past events. Okay, let's make sure we can see that. So it has to be controlled by an entity as a result of past events. So this is in an effort to prevent people from coming up and saying, we are planning to buy a car and therefore we control a car and therefore we can recognize a car. If it's not in the past, if you didn't go out and buy a car, you cannot recognize it as a car. So an asset has to be a resource controlled by an entity as a result of past events, and which will result in an inflow of resources to the entity embodying economic benefits. So if you have a vehicle, you expect that you could use it to maybe rent it out and make money off it, or you could, instead of paying somebody to come and offer you taxi services, you then save and have money coming in. If you have a building, you can rent it out and you'll be receiving inflow of resources. So the same reasoning is applied to the rest of the definitions as you go on and on and on. I think the rest of the material, as you go, just read. If you can't remember this, try and memorize it so that you can then explain more if you are asked to explain in an exam situation. For each of those elements, we'll look at two things as I described earlier on. We'll look at how you recognize them, and recognition is simply the process of incorporating the elements in the financial statements. So if you have a transaction, pause here for a moment and think of you are sued. I like giving this example, right? You are sued and the person who sues you wants you to pay 10,000 kwacha, saying you supplied them substandard goods, they got affected and you need to pay them 10,000 kwacha. How are you going to recognize this? Is it going to be an asset, a liability, income, an expense, and so on and so forth? To choose how you do that, you need to know what's called a recognition criteria. And the conceptual framework provides that the recognition criteria, which is a process of incorporating elements in the financial statements, is supposed to be like this. First of all, for this to be recognized, you need to meet the definition of an element. So what type of element does that amount suit? Number two, it should be probable that future economic benefits will flow to or from the entity. Okay, so if this is an asset, it should be probable that future economic benefits will flow to the entity. If it's a liability, it should be probable that future economic benefits will flow out of the entity, and the similar reasoning will be applied to income and expenses, even equity. And then the value of the item can be measured reliably. So if someone asks you what are the recognition criteria for an element, under the conceptual framework, what you need to tell them is that number one, it must meet the definition of an element. Number two, it must be probable that future economic benefits will flow to or from the entity, and then number three, the value or cost of the element must be reliably measurable. Try and remember those. You see how we apply them to different elements as we go on in the different chapters that we'll be studying. The final part that to look at in the chapter is measurement of elements of financial statements. To measure an element of financial statements, there are four major bases or ways of measuring that the conceptual framework stipulates. There's what is known as historical cost. So historical cost would simply involve going back into the books of account and using the amount at which you bought an asset or the amount at which you spent over something, and that's what you use to recognize your element. You could also use realizable value, which is most likely the amount that you're going to gain if you had to sell the asset. We could use current cost, which is the amount at which the asset is worth in the books of account, and current cost would lead to, you're going to be looking at this word a lot as you go on in your studies, revaluation. Okay, and you've probably come across it in other studies, in your financial accounting studies most likely. You could also use present value, and we'll get to see how we use each of these to measure different elements of financial statements. So in summary, the things that we've looked at in this chapter are, we try to define what a conceptual framework is. We try to explain the advantages and disadvantages of a conceptual framework. We looked at the objectives of financial statements, the underlying assumption when preparing financial statements, and we said that there's also an additional one in case you're asked for two. The qualitative characteristics, remember FRTV, of financial statements, the elements of financial statements, recognition of elements, and measurement of elements of financial statements. To consolidate this knowledge, go through the notes and please read the exam focus that you have right at the end of the chapter there. If I can do this, I will allow you to see this, pause the video, read the questions and solve them, and then when you're done, you can say goodbye to chapter 1 and start consolidating chapter 2. Thank you for watching.